Well, we're going to have a great show today, Kyle. So great to have you on the show, as always.
Yeah, thanks for having me.
We're going to be talking about dividend dynamics today. So we're going to be talking about some myths, unraveling them, specifically about dividend stocks. And then we're going to talk about some of the basics as it pertains to understanding a stock dividend.
Okay, well, you've been doing this a long time. Mm-hmm. You were really big into dividends. You got me into it, and man, it's been fun. But I heard this story the other day, and I'm curious if you think it's true or false, because I wasn't too sure. So there was this lady back in 1944. She invested about $5,000 into dividend-paying stocks. That was it. By the time she passed in 1995, she had $22 million in her account. You think that's true or false?
So I know of that story. Yes, I think that is completely true. I don't know the full details, but I think she was a secretary of somebody.
Yeah, she worked at the IRS. They said she never really made that much in salary. She had no inheritance. It was literally just allowing her dividends to reinvest over time. And
it's stories like that why I love dividend stocks. You know, like you in the best of times when the market goes up, you know, for the most part get to share an appreciation as the stock grows. And when the stock market draws back or the stock that you own just falls in value, those dividends get to buy more at a cheaper price. It's like you win in no matter what scenario you look at. I love the dividend stock.
Well, before we get a little too far, what is a dividend? Like when we talk about dividends, do you have any examples?
Sure. So let's think of an orchard, like an apple orchard, where, you know, you have this orchard, this row, the bunch of trees, you own the dirt, you own the apple orchard. And a couple times a year, I don't know much about orchards, but you get to harvest the fruit that comes from these trees. So you get to sell that. It's money in the bank. You have the value of this orchard, and you have all of these trees that produce a crop that you can utilize. You can eat it or you can sell it for profit. That's the same as a stock. You have a stock that produces a harvest. It could be once a year, it could be 4 times a year, it could be monthly, where they're paying you some form of cash, some form of payment, and you have the asset itself. So you've got this farm, this orchard, and you have this product, this revenue, money in the form of a dividend. So that's a value stock, that's a dividend stock, very different than a growth stock. So a growth stock would be like a parking lot.
So just a blank piece of dirt,
gravel, cement. There's nothing of value other than the plot of land, the dirt itself, where you have to buy low and sell high, but there's nothing that you get along the way, as opposed to buying value where you have some sort of cash or other incentive to hold the stock. So you get paid almost like rent, to hold this dividend stock, which is such a great thing. That's why I'm such a big fan, because our clients, a lot of them are retired and they need income. So we don't have to sell anything to generate income. They just hold positions, get paid to hold those positions. The market does its thing, goes down, everybody gets upset. It goes up, everybody gets happy, but they're getting paid along the way.
The whole time.
Yeah, the whole way.
That's one of the things I love. And, going back to that apple orchard, it's not, you can find places where it's consistent. It's not guaranteed to always have this giant harvest, but it's very predictable. You're getting that, the income, the harvest each year. I love it.
So how do dividends work? Let's just jump into dividend basics. So let's just kick off, not necessarily an illustration, but how they actually work. So
a dividend is basically a payment that is made by the company to its shareholders based or from its profits. So the company goes out and they have something of value, they sell that, and they allow their shareholders to share in the profits of the company each year. And like you said, sometimes that's paid out quarterly, sometimes it's paid out monthly.
Yep. And then there's also different types of dividend. You've got the most common type, which is a cash dividend, right? It's money
Everybody
in the
loves
bank.
that one.
Everybody loves that one. So however the company sets up, they're going to pay monthly, quarterly, semi-annually, annually, or even in the form of a special dividend, which we're going to talk about in a minute. The company decides how they're going to make payment. Once they decide how they're going to make payment, they can do a cash distribution. So on that schedule, they say, hey, on this time, we're going to pay X percentage of our profit, or however they figure out how they're going to pay it. I think it was designed to be a portion of profit. It still is, but sometimes I don't know where they come up with their numbers. We're going to get somebody on the show to figure that out, because sometimes the math just doesn't work out in my mind.
Right.
Then you have a dividend. In the form of a stock, a share. So instead of giving cash, they might actually just give more shares, which is almost like a reinvestment.
Right.
So you might have started with, 10 shares, they pay a dividend, now you have 10.1 shares or 10.4 shares, whatever it is.
Which those types are probably fine if you're in that accumulation pre-retirement. That's fine because you're just reinvesting anyway.
Yep.
And you want more shares.
But I would like the option personally to be the cash, where I can either buy more shares or I can take the cash. When a company, it is very common, but sometimes you get to elect it, where you're like, hey, just give me shares, don't give me cash. And you can go back to the company and say, now I want cash, don't give me the shares. And then the only other very typical dividend type would be a special dividend.
And people really like this one.
Special dividends are great because they're almost like a surprise. You're getting quarterly dividends. They're paying you X amount of dollars per. Oh, one thing we should make note on, and this just hit me. It's a dollar amount. So when we're saying a cash dividend, when we're saying it's a percentage of profit, I don't want people to think, hey, I've got, $100,000 of stock and I'm going to get a percentage of profit of the company every quarter. So the dividend isn't predictable. The profit goes like this one quarter, this like another quarter and up. And I'm just going to get a percentage of that. That is not how they work. They will set a scale where they're saying, okay, I'm going to pay $4 in dividends
per share, not based on account value.
Correct. So you're going to get $16 of dividends by the end of the year, and they're going to pay $4 per quarter. Say they pay in a quarter. It doesn't matter if the stock price goes in 100% of growth in a year, or 40% loss in a year. You're getting $4 of cash per share you own. It's very predictable, even though the stock price is unpredictable. That's why another reason we love it is because you know what you're going to get when they say they're going to pay it. And then, well, I don't want to get too ahead of ourselves, but what happens when they don't pay, or what's that? We're going to talk about that myth here in a little bit. So that's another one, but let's finish on the special dividend. Yeah. Why is this such a good deal again?
Well, because you have your normal pay structure, whether that be quarterly or semi-annual or whatever. But then the company, sometimes they just have a really great year. And there's a ton of different ways that they can go about that. They can pour it back into their company. They can buy back shares, or they do this special dividend and they reward their shareholders. Like we were just looking at one company, Coke Consolidated, that's here in Charlotte. So it's kind of cool that they're where we are, but they just paid last year, I believe it was a $16 special dividend that was on top of all their other dividends throughout the year, which, talk about
as
a happy
shareholder,
Christmas.
You're like, Merry Christmas. Hey, we paid you all this dividend.
Yeah.
And, hey, we had such a good year. We're going to pay out a special dividend. For every share you own, you get $16. For every one share, you get 16 extra bucks per share.
Per share.
Man, that can add up quick.
Yeah, it can.
Okay. And then, so let's talk about why to invest in dividends. So what are the advantages of investing in dividends?
You already alluded to it. One of the biggest reasons we love it, and our clients do, is that income generation, because you are actually getting something really that's tangible for owning those stocks. It's not just this opened up my account and today it's up 5%, tomorrow it's down 3%. Like you're not having to ride the roller coaster so much. Like, you know that at the end of the quarter, you're getting some type of cash payment that actually goes into your account.
That is a huge thing. Another one is compounding growth. So this is probably one of my favorite ones. When we've done research on this in the past, and as we talk to certain clients, or circles of influences like CPAs or attorneys or things like that, we'll get challenged. And I love that. That's one of my favorite things. It's not like we're getting challenged, but they're challenging the concept.
That's right.
Of dividend stocks, because they're like, well, I thought dividends were for old people. Sure, they're for every age person, right? Right. And the compounding growth advantage is one of my favorites, because if you look at the S&P 500, that's kind of the gold standard of indexes, right? And the dividend, about 60%, 65% of the S&P are stocks that pay dividend. And the S&P has been around since stocks have been around, right? If you take the dividend out of the S&P, it loses 51% of its total return. So the S&P on average grows about 10%, just over 10% per year. If you take the dividend portion, which only 65% of the companies pay a dividend.
Not even all of them pay.
So 2/3 of the entire index pay, 1/3 doesn't pay it at all. So if you look at just the dividends on the 65%, that compounded growth is 51% of the total return of the S&P. If that doesn't tell you how much of an advantage dividend is, I don't know what other stat I can put in front of you. Because 2/3 of the index pay it, and it accounts for 51% of the entire return. That is a staggering statistic.
Well, I mean, it's that when we talk about like reducing the volatility of your
that's another
account,
advantage.
Like, it helps mitigate all that, because that is positive growth going back into your account every quarter.
Yeah, it's a big one. Another one here is hedging against inflation. So it's no secret over the past couple of years, it's been really bad from an inflation standpoint here in America. And, the dollar doesn't stretch nearly as far today as it has in the past. And dividends are great. And one of the biggest reasons that it hedges against inflation is because they're not typically stagnant. So now they can be. You can have a dividend stock that just pays $1 a share and it never changes. And plenty of those out there. But you also have companies that is part of their culture. The reason why you buy their stock is because they increase their dividend year over year. And that's one of the things that we do very well for our clients, is making sure that we find companies that have a culture. It's just part of what they do, that when you buy it, the next year they're going to pay you more.
Right.
So when you have these times, these economy situations that we're in now, economic, where you've got salaries that are kind of trending down and people are getting pay cuts, job cuts are pretty bad, and prices have gone up. When your portfolio, you're like, well, I'm getting paid more this year than I got paid last year, which paid more last year than it did the year before. That's a big hedge against inflation, right?
Yes, absolutely. And it also goes, all these kind of work together, because as you're explaining that, I'm like, and that's even another way that the compounding growth and this reduction of volatility, like,
that's why it's 51% of the S&P.
That's right, because they're increasing this dividend payout, which just builds up your return over time.
Yeah,
it's great. And then there's also all kinds of tax advantages that come from dividends, especially if you're in like a brokerage account, because it gets taxed a little differently than just normal income.
Yeah, it's a huge advantage.
Yeah. So
tax as a whole, stocks as a whole, there's some pretty substantial tax advantages if you hold it for more than a year.
Right. Yeah.
And most dividend stockholders, they're not buying it, turning it to sell some profit,
That's right.
to live. They're holding it for a lot longer time, which means there's much better tax advantage.
Yeah, it's great.
And then two other things that we could probably quickly talk about is it's an indication of company health. If a company has continually paid a dividend for 40 or 50 years and increased half of those years their dividend, what's that tell you about the company?
got to be turning a profit
Yeah.
because they'd be out of business if they're paying it all
If
out.
you look like, they first started paying their dividend in 1920 and it was 20 cents. And they're paying a dividend today and it's $5 or whatever the dividend is. And they've incrementally increased their dividend. They've never missed a payment in 80 years, 100 years.
Yeah.
And we have companies that have been paying 130, 140 years. And they've never missed a payment.
Yeah, we've got a couple that have been consecutively increasing over 60 years.
60 years. What's that? I mean, that you got to sit back and go, well, look at the stock. Yeah. Look at the history of their dividend.
That's
They're
right.
Going anywhere. Those are great. They're just short term. The market doesn't like them. And a great example of that was in 2023. The dividend arena, actually just about every arena, every sector of the market outside of just a very small sliver that really controlled most of the market growth, which is tech. Outside of tech, everything, was marginally increased, yet the market boosted these huge returns. But the vast majority, about 90% of the companies out there, barely grew because the economy's wasn't that great. Dividend stocks mudded along.
Yep.
But the long term of that is actually good. And we're going to talk about that here in a little bit. But seeing a stock value, a dividend stock value go nowhere is actually a really, really good thing.
Not always a bad thing.
Not always a bad thing.
Yeah.
All right. What else we got here? Let's talk about some myths.
Yeah. We get a lot of these. Just people, as we're educating our centers of influence that we're talking to that think that we're, talking about all kinds of crazy stuff. So one of the first myths that we have is dividend stocks don't offer significant returns.
How can we blow that up? I think I already gave an example that blew that up. If you look at, the S&P 500, I'm not going to belabor this, but it's 500 of the largest companies, right?
Yep.
This mix of stocks, there's 500 of the largest companies out there. 65% of them pay dividends. And this is the gold standard. When you want to look at the market, you look at the S&P 500 or the NASDAQ. The NASDAQ is because we're turning tech. It runs the world.
Yep.
And then we want to look at the big companies and see what they're doing. When you look at those specific companies, they're measuring the entire market. Well, if they're averaging over 10% a year and 65% of them pay dividends and it accounts for 51% of the return, this myth is blown up right out of the gate.
Well, and that's, look, if you were to own all of those companies individually, or if you manage your own portfolio or whatever, and you have individual stocks, you should take a look at some of the companies that you own because they very likely pay a dividend and you just don't even know it. But these are also reasons why I feel like mutual funds, when they go and buy stocks to hold in their funds, they're buying a lot of these companies that make up that S&P. And yes, it can be the U.S. Global Fund or whatever they're naming it, but they know the power of dividend and they're wrapping it up into this mutual fund and allowing that to support their returns so that you get what you need from a mutual fund, which is funny. And that's where we just let's go allow our clients to actually own those stocks themselves so they get the full benefit of it instead of some type of fund getting some of it.
Well, what's unbelievable to me, when the market struggles, the big money, the money managers out there, they move to dividend.
Right.
So dividends are the safe haven of the market when there's so much volatility out there. When there's a lot of growth to be had, they will leave the safe haven of dividends and go chase growth for a time until they have to return back to the safe haven. Yet the safe haven sometimes can outproduce the big growth.
Right.
But not always. So we have consistent income and we have consistent growth for the most part in dividend stocks. And then for seasons, there's sectors of the market that big money managers will go chase.
Yep.
That doesn't mean these are conservative or they don't offer returns. They might not be as good for times in the market.
Just that return looks different.
Yeah, it can. Like there's some stocks that outperform all other stocks.
I mean,
for seasons.
Like there's a couple other
Nucor is consistently outperformed.
Just doing really well.
So another myth is dividends are only for conservative, risk-adverse investors.
I mean, you were just alluding to that. It's steady, consistent. It's kind of the tortoise.
Mm-hmm.
It's not the rabbit. It's not the hare jumping out there.
Well,
not always, at least.
Well, the crazy thing is, I've heard so many people over the years say, I wish I could have bought Microsoft when they went public, or, Apple or Amazon, whatever. Of those 3 stocks that I just mentioned, 2 of them pay dividends.
And they've been paying it for a long time.
For a very, very long time. So nobody looks at an Apple. They look at Apple and they go, oh, that's a growth stock. Actually, it pays a dividend. It has for 14 years now.
And it wasn't always a growth stock.
No. So I wouldn't say Apple or Microsoft, or actually NVIDIA pays a dividend as well. Very, very tiny dividend. But NVIDIA was one of the best stocks in 23. I mean, it blew up. It changed the face of the market almost.
That's for sure.
And looking at that, I mean, that's another dividend paying stock. I don't know anybody out there that would buy NVIDIA because of its dividend, but nonetheless, it still is. So I think this myth is blown up because of the type of stocks out there that pay dividends, that are considered growth stocks, yet they still have a dividend. And the vast majority of money managers utilize dividend stocks to stabilize and grow their portfolio when it's really difficult, when it's super volatile in the market.
Yeah.
So, all right. High yield dividends always mean high returns. This is an interesting myth. The myth is probably, hey, we're going to chase this income, this high, let's just say it's a 12% yield. And they're like, well, I'm going to make at least 12% return. That is a myth.
And I think a lot of that is you get people who think that the dividend is tied to the share price.
Yes.
Which it's not.
It's not.
It's 2 separate conversations. They're not even really in the same.
Volatility is uncontrollable. And
it's always going to be there.
You can have a company that blew up from a performance standpoint, from a financial standpoint. So they did more revenue, they got more clients, they boosted operations, they boosted net revenue, and you can see the stock price plummet. And a great example of that was Amazon in 2021. 2001.
Yeah, for years. They had great financial years.
But the stock price suffered.
Stock price suffered because they continued to pour money into their bigger vision.
Yes.
They were thinking 20 years.
Well, sometimes, the talking heads, the pundits out there, the people who move the market just don't like a stock. And yet the stock is the company is making all the right decisions. Their trajectory of growth is really, really strong. And yet the stock price just suffers.
Yeah.
But the company is booming, busting at the seams in just a matter of time.
What was that story? I mean, finish it. You were saying that year.
So in 2001, and I give the example of Amazon.
Yeah, because who wouldn't want to own it now, right?
Statistically, financially, that company, I wish I had the example in front of me, made all the right decisions. They more than doubled their revenue. They expanded their operations. They got 40% more clients that year. They expanded overseas, and their overseas grew 180%.
Wasn't their net profit up 80%?
It was crazy. Their net revenue grew to 1.2 billion from 600 million. Their gross revenue exceeded double what it did the year before. I mean, when I gave this example, I read all the crazy things that happened. I mean, you look at this, you're like, man. And I did it this way because I was like, well, what do you think happened to the stock? And everyone's like, oh, it doubled, tripled, the stock blew up. But knowing how I was asking, it was it went up 10%. They're trying to be conservative. Be like, well, it only grew 20. But in your mind, you're like, that stock had to explode. And the reality is it dropped 87%.
Just bizarre.
And that's why the value of a company, the volatility, the stock price, may not exactly mirror what's actually taking place with the company, because the market is emotional.
Yeah.
It's driven by so many outside factors of the news. I mean, today, they're looking moment to moment and whatever the headlines read, and it can affect the market. Yet when you talk to a financial mind like a Warren Buffett, or you watch any of his interviews, he buys on financials. He buys on what the companies are actually doing and how they're growing and why they're growing. He's looking at the things that most pundits, I would say 99.9999%, they're just looking at the headlines. They're looking at the motion of the market, and they're selling advertisements.
Charting, right?
Yes.
Like, what does the chart say?
He's looking at the company going,
yeah,
man, this company is valued at 300 million or whatever, 3 billion, and it's a $20 billion company.
Yeah, it's trading at like one time earnings.
Yeah, like, he's like, this is a steal.
Yep.
You know, and let's go buy this. We can turn this around and we can make money regardless of what the price of the stock looks like.
Right.
And that's what he does. He thinks on a different level, and that's how we buy. We buy stocks based on financials. We don't necessarily buy stocks based on their price of stock or the volatility of that stock. Everybody looks at that and everybody thinks that's important. I'm not necessarily going to disagree, but the financials trump the volatility of the stock price always, because the stock price can change.
Right.
The financials, I mean, they run the company.
Yep.
So we can tell if that company is destined for failure or success just by digging in.
Yep. You
can't look at a stock and go, oh, that stock has grown for 5 years. It's going to continue. It could turn around tomorrow.
I mean, especially in the world and the environment that we live in now, where literally one social media post
can devastate,
can crush a company or set it off.
Because it's a viral video.
Yes. Like these Stanley water cups. Like their company experienced an explosion of growth all because of one 40-ounce water jug. They didn't even know what was coming. And it was one influencer. Like, it's just wild. And then you get people like Tesla. Nothing's changed with their company, but because their founder is creating news on his personal views, it's dictating the share price.
And right now, we're having a government make headlines based on what their agenda is. Now people don't want to buy that product.
You've got some of these great companies that create consumer goods that are faltering because of the arguments around whether you should have gas stoves.
Political. Right. All right, another big guarantee we need to talk about is dividends are guaranteed income.
Yes,
is that a myth? Or is that real?
It's definitely a myth that it's guaranteed. It is not guaranteed. Like, there are other products out there that you can have guaranteed income. But as we tell our clients, dividend income is predictable, and there's a lot of resources that we use, a lot of education that we go through. That's something that we like to do kind of early on, is teaching our clients, hey, look, it's not guaranteed, but based on a company's history and what they have done in the past, 40 years of paying a dividend, 100 years of paying a dividend, it's predictable. And that's also why we're here. We're here to be a part of that process and make sure that we're listening and doing our research on these companies to find out, hey, is their balance sheet also is it confirming what they're saying?
But the reality here is, on dividend being guaranteed, is that is a 100% false statement.
Yeah.
They are not guaranteed under any circumstance. When you get paid a dividend, they can say, hey, that, we're going to pay these dividends, but if things change,
right.
Like the pandemic, in 2020, the world blew up, everything stopped. There were companies that year that had to adjust their dividend because profits fell off the map. In our portfolio of all the stocks that we had held in that year, we had one company stop paying and we had one company reduce its dividend out of all the stocks. So even though only two adjusted, the rest paid, none of them were guaranteed.
Right.
No dividend stock income, to my knowledge, is going to be guaranteed. They will all be, on the merit of a company.
Yeah. It only gets guaranteed once they declare it. And you've got that
then you have to
3-week
pay.
period. Yeah.
Another myth is only older established companies pay dividends. This is a quick one.
Yeah.
That is a myth. It's true in the fact that most older established companies pay dividend, but it is actually a myth because you can have very young 5-year-old companies, 10-year-old companies pay dividends.
Yep.
And I don't even know what older means there. Is that like a 50-year-old company? 100? So it is a myth because there is no timetable. Any company can pay a dividend.
Last one, investing in dividend stocks means you're sacrificing growth potential.
We've already discussed that at length. We don't need to discuss that anymore. Yeah. That is a 100 wholehearted myth. That is not true at all. So let's talk about some fears. So here we've got, when you're thinking about a dividend stock, what are some of the fifth? We just went over the myths, these things that just are not true. But there's also some fears of buying a dividend stock.
And some of them kind of go hand in hand to what we were just talking about. So like this first fear, market volatility negatively impacts my dividend stocks.
That fear is a reality when the economy or the market is suffering and you see red. Are dividend stocks going to go down like every other stock? Sure. Are they going to stabilize? Sure. Can they grow? Sure. We don't know what's going to happen with the volatility of a stock, but we do know they're going to pay consistent income.
Right.
So when the market is suffering and you're retired, in my opinion, there's no better place to be in the market than in a dividend stock because you're getting paid to hold that volatility.
Right.
You had a portfolio that's worth $1 million. Now it's worth $700,000, but the income that you were generating when it was valued at $1 million is the same income that you're generating that is valued at $700,000. Should you sell your stock? You don't have to. Nothing's changed.
Right.
You're upset. You lost $300,000. Have you? You didn't sell anything.
Right.
You
just quarterly,
your statements show $300,000 less value. Nobody's happy about that.
Right.
I understand that. But until you actually take action, it's just on paper. And when the market returns, the economy comes back, the reality is the market goes up and down, the economy goes up and down, and stock prices are dictated by all of that. And if you take a snapshot in any period of time, your emotions either go that way or that way. But as long as your income is determined outside of that volatility, right, you can live a much, much happier life because you're not as emotionally attached to the volatility of the market.
Yeah. I like the way you said that.
So next fear is dividends will be cut during economic downturns. We talked about this when I was talking about, the 2020 pandemic. Of all the companies, all the stocks that we hold for all of our clients, only 2.
Yeah.
And this was the worst. I mean, can you imagine, like, if I was like, all right, it's 2019. Imagine if the world stopped. Like everything that we know, like computers, e-commerce, like going into a store. Imagine if you couldn't go into a store to shop. Like this is the America. Imagine not being able to leave your house. Like, could you fathom that? What would happen to our portfolio if the world shut down for a month? Like, what would happen? Could you be like, that'll never happen. Like, why would you even bring that up?
You still buy stuff.
Yeah. Yeah, it still happens. Well, what happens when everybody needs to buy stuff and there's not enough to go around? Remember the toilet paper issue?
Oh, man.
That was so bad. I was like, we're going to run out of toilet paper. That was so bad.
It's just the most random things were running out.
It's so weird.
And then certain things you were like, okay, that makes sense.
So the fear is real. The reality is 2 stocks. Our portfolio income at its worst went down 4% and the world shut down.
But the value,
the value went down 40%
in like 2 weeks.
But the income dropped at its worth 4% and was up 15% by the year's end. Not to mention the value had almost come completely back. So this is a legitimate fear. But the reality is if you do a good job managing and picking the right stocks, we can mitigate that fail greatly.
Right.
And we personally have been battle tested. Our portfolio has been battle tested. I was confident before 2020. Now it's like, forget it.
Yeah.
Like the foundation has been laid.
Yes.
Like I am forever going to be as confident as I could be looking at, a dividend portfolio. Cause I don't think we could, knock on wood, there's no wood around here.
Yeah.
I don't know if we could find ourselves in a situation that would be more scary.
Right.
than
Yeah.
the pandemic.
It definitely feels
For the
like
market,
modern history. Like
That was it.
that's a great benchmark for what you're
All
investing
right.
in.
Another one. Inflation will erode dividend income. That was a myth.
That's a myth. It's a real fear, especially whenever you're seeing 7, 8%. And at the end of the day, we've talked about this already. As long as you're smart in the stocks that you're picking and that those companies have a history of increasing their dividend, not just paying a level $1 per quarter, you can help really mitigate that and the erosion won't happen.
Another fear was overexposure to specific sectors with dividend stocks. So let's get into this a little bit. So Warren Buffett in this space is gold. He has a famous quote that says diversification are for people who don't know what they're doing.
Oh, it's my favorite quote.
Such a great quote. Feel a little boastful when I say something like that. But he's the one who said it, not me. But diversification in reality are for people who don't know what they're doing. When you're looking at dividend stocks, you're definitely going to be overweighted in utilities, gas companies. There's certain sectors of the market that just are littered with stock dividend companies. And other ones, like if you look at utilities and tech, which ones are going to have more dividends, right?
Right.
Utilities is going to be like this, like
energy.
You have, what we live on. And if you think about your everyday purchases, the things that you live, your food, your toiletries, what runs your life, the vast majority of those companies pay dividends.
I mean, to food companies,
utilities, energy, what we consume, all of that pays dividends. On the other side, what we utilize from a tech standpoint, not so much. You look at things that we utilize in the computer world that run businesses like, Microsoft and Apple.
But they're even like the hardware that you use every day.
Yeah. Software companies.
Kind of the products, right?
Hardware.
Yeah.
Is more prone to paying dividend. But the fear is real. The fear is, hey, if I want to build a dividend portfolio, I'm going to be sucked in and not be very diversified. I'm not going to have 7% into every sector. I don't know.
And I'm only going to be in the US.
This is one of these things where I scratch my head. I'm like, why is this a bad thing? Like, why is looking at certain sectors and not being spread across? I mean, the founding financial, theology in this world is in the United States is you have to be everywhere. To do my job and give the good advice, I got to have people so diverse that they're never going to get hurt. Yet the greatest financial mind in American history, Warren Buffett, is like, yeah, that's for people who just don't know what they're doing.
Well, and you can get diversification through some of these companies.
Yeah.
Like just think about a Coca-Cola. They're headquartered down in Atlanta. They're sold all over the world.
That's sold more than water.
Yes.
Like when you go to Mexico, there's Cokes on every corner. They're not even selling water because you don't know if it's been contaminated.
Right.
But Coke, has been filtered.
And Walmart, they have stores everywhere and sell everything in them. And they pay a great dividend. And I would say that is yes, you may be invested in Walmart, but they are one of the most diversified companies out there. So like you can find diversification can look very different and still achieve the same goal.
Another one, rising interest rates. We've already talked about this, will make dividend stocks less attractive. A legitimate fear. And I would say that is something guys like us have to deal with when interest rates go from 0 to 8 and our portfolio or a portfolio that's being managed is at 5%. Well, when interest rates are at 0 or 2, 5% looks great. When interest rates are at 8 and money markets are at 6, why would you buy a dividend portfolio? There's a legitimate fear there. With money markets, stagnant rates, they will fluctuate up and down as the economy, as the feds want to make whatever decisions they're going to make. And there's no outside growth. With dividends, you're always going to have that dividend yield, whatever it is. Then you also get the opportunity of growing the value of that underlying position as well, which in a money market, you're never going to have that.
Right.
The reality is it's a legitimate fear. And sometimes in certain situations, I might say, hey, chase the cash. Knowing what I know about dividends, I would never do that.
Right.
But in specific situations, it's not a bad
short
idea
term.
for short.
Yeah.
If let's just say you had $300,000 in the portfolio and it was earmarked for a home or it was earmarked for something.
Yep.
I would never say put that in the market. I'd say chase that money market account all day long. So the advice has to match the purpose of the money, but in interest rates will always dictate certain decisions for stock yield, for stock dividend, because it impacts it.
Sure.
High inflation actually will make some companies push their yields up because they get more yield on their cash, which means they can pay more on the dividend side. So I don't look at this as a negative thing. I look at this as a smart thing.
Yeah.
Like there's opportunity. All right, another one,
good.
Missing out on growth opportunities in non-dividend stock. Legitimate fear. We've already discussed that.
Yep.
Sure. Yeah. Yes. The reality is certain non-dividend stocks are gonna soar. Like, like Tesla doesn't pay a dividend, Facebook doesn't pay a dividend. Some of those stocks in 2023 just exploded.
But in 2022, they fell off a cliff. So you're on this roller coaster ride that you've got to be like, at what point also do you transfer whatever growth you have gotten? At some point, it has to become income for you once you hit to retirement. So when do you get off the roller coaster and switch?
I feel like to appropriate answer that fear, it's very time sensitive. There might be for a time you chase growth specifically on money that you don't need to produce something. So if you have pots of money, like, hey, I have, and this is where planning comes in, I have this income need. You have $1 million of assets and you need $40,000 of income. Well, you don't need a whole $1 million to produce 40 grand. So you figure out how to produce that 40,000. You go do that and you have this other pot of money that you don't need to generate income from. Should you use that to go chase some income? That opens up the discussion. Chase some growth.
Yeah.
Now, when you're looking at your plan, you've solved your need.
Yep.
Now you've split and organized your assets. Now the conversation could be legitimately had back and forth where you can make strategic decisions that are not going to impact your income.
Right. They're not affecting what's paying the bills.
This is why planning becomes so important. It's not just the product, the portfolio of dividends and stock or growth or whatever it is, or annuities. It's, hey, let's build our plan appropriately. Let's figure and organize that out. And then once we have solved for our income, we can decide, do we want to chase any of this other thing? Do we want to safen up our portfolio, get some money market, whatever? I know we're getting a little off track here, but this is an important discussion because we're talking about dividends. We love them. We use them all the time. There are other assets out there, asset classes out there that we can go put, but it has to be completely organized through your plan.
Right.
First and foremost. So let's wrap. Let's land this plane.
Yeah.
We've talked about a ton, some myths, some fears. We've talked about a story and gave some insight on the dividends, at least the basics. Hopefully it's been educational. I know it's always fun for us. We could talk about this all day. I don't even want to end because I love this stuff, but we need to end the plane. Any other nuggets you want to throw out there?
It's always fun, like you said, to dig in and discuss this stuff. And it's fun to really start looking at some of the companies that we invest in and see what they've been doing over time.
As always, if you have any questions out there and you need further explanation, or you need some answers that you can't get on this show or that you can't find online, you can always reach out to us. We don't normally, I'm not trying to market anything. We just want to be a resource for you. So if you have any extra questions, feel free to reach out to us. Other than that, hopefully you enjoyed the show. Thanks, buddy.